Hello and welcome to A Accounting Tutorials. This is the part 4 of the IFRS 16 leases. In this particular video, I want us to take a full practice question on how lease transaction will be accounted for in the financial statement of a dealer lessee, where we will be using the concept of annuity factor to determine the lease liability of the lease transaction. Is that okay? But take note that in the part 2 and 3 of this particular video, we've already looked at questions where lease payments are made in arrears and in advance, where the cost cash price of the asset is given. So it becomes very easy to determine the lease liability of the lease transaction at the commencement date, that is at initial recognition. But in this particular question, the cash cost price is not given. Okay, so it becomes quite difficult to determine the initial lease liability at initial recognition. So we'll be using the annuity factor in order to determine the initial lease liability at the commencement date. So if you haven't subscribed to this channel, kindly subscribe to this channel, turn on your notification bell so that any moment I upload any new video, you'll get notified on your devices. So let's quickly go through the question so that we see how the lease transaction will be accounted for in the financial statement of a dealer lessee with application of annuity factor. So let's quickly go through the question.
A Limited began to lease a property on a 10-year lease. A Limited prepares financial statement to 31st December each year. On 1st January 2020, the annual lease payments were 500,000 Ghana cedis payable in arrears. The first payment being made on 31st December 2020. AE incurred initial direct costs of 100,000 Ghana cedis in arranging this lease and received lease incentive of 50,000 Ghana cedis. The annual rate of interest implicit in the lease is 10%. When the annual discount rate is 10%, the present value of 1 Ghana cedis payable at the end of years 1 to 10 is 5.88 Ghana cedis. Required. Show how the lease will be accounted for in the financial statement of A Limited for the year ended 31st December 2020 and 2021 under IFRS 16 leases.
In solving IFRS 16 leases question, the first thing to fetch out from the question is the cash cost price of the lease item or lease asset. But in this particular question, the cash cost price is not given directly for us to get our initial lease liability. So we will adopt the concept of annuity to determine that. Good. The next thing to also look at is the annual lease payment. In this particular question, the annual lease payment happens to be 500,000 Ghana cedis, but it is payable in arrears. This means that the payment is being made at the end of the financial year. Is that okay? Good. And there is also an initial direct cost of an amount of 100,000 Ghana cedis, and there is a lease incentive of 50,000 Ghana cedis given by the lessor to the lessee. Is that okay? But one thing I want you to take note is that the interest rate implicit in the lease is 10%. That is what we will use to determine our finance cost at subsequent measurements. But there is one thing I want you to take note. At the very last part of the question, it says that when the annual discounted rate is 10%, the present value of 1 Ghana cedis payable at the end of year 1 to 10 is 5.88. So this 5.88 is the annuity factor. This will help us determine the initial lease liability. Is that okay? Also take note that in solving this particular question, the standard says that at initial recognition or at the commencement date, the lessee has to recognize the lease liability and right of use asset. That is the very first thing we have to do. So let's do that. So initial recognition. So at initial recognition, the lessee recognizes the lease liability. Good. And 2, right of use assets. I told you that in this particular question, the cash cost price of the asset is not given. If it is given, we will choose that, or we will take that as the lease liability. But because it is not given, we adopt the concept of annuity to do that. So we use this formula, that is annual lease payment we multiply it by the annuity factor. The annuity factor. The annual lease payment in this particular question is 500,000. And the annuity factor in this particular question is 5.88. The lessees adopt the annuity concept because same amount of money is paid periodically. Is that okay? So when we multiply these two, you get an amount of 2,940,000 Ghana cedis. That is at the commencement date. The lease liability happens to be 2,940,000 Ghana cedis. So after looking at the lease liability, the next thing to look at is the right of use assets. So the component of right of use assets, the first component I would like to talk about is the lease liability itself. So I'll say lease liability, and the lease liability is 2 million. I'm picking it from here. So it's 2,940,000. Good. As the initial lease liability. The next thing to consider from this question is the initial direct cost. So there is also initial direct cost. There is also initial direct cost of an amount of 100,000. Good. After looking at the initial direct cost, there is something we call lease incentive. Lease incentive, it is given by the lessor to the lessee in order to reduce the cost of right of use assets. So the lease incentive in this question is 50,000 Ghana cedis, because it is given out to reduce the total right of use asset. We put it in brackets. So when we add the lease liability to the initial direct cost and we subtract the lease incentive, you arrive at an amount of 2,990,000. So this is the right of use asset at initial recognition. The standard says that at the commencement date, after initially recognizing the lease liability and the right of use asset, the next thing to do is to subsequently measure the finance cost and how this finance cost will impact on the financial statement of the dealer lessee. Is that okay? So subsequently, we use what we call amortization schedule, or a schedule of lease payment of finance cost. Okay, so we prepare this schedule in order to determine the finance cost and how its annual lease payment also goes. Good. So let's look at how the schedule looks like. So subsequently, this is how the schedule of lease payment and finance cost look like. Is that okay? So, but take note that payments are being made in arrears. So payments are being made in arrears. Take note that the payment model determines the structure of the schedule of lease payment and finance cost. So take note that in this particular question, the lease payments are being made in arrears. That is, lease payments are being made at the end of the financial year. So we begin with the year ended. Then we continue with the opening lease liability. The opening lease liability happens to be at initial recognition. We've recognized the lease liability. and I've just cleaned it. So you can see the lease liability we had at initial recognition. So that will be at opening lease liability. Then the finance cost happens to be the interest rate implicit in the lease here is 10%. So when we apply that, that gives us the finance cost. Then the addition of the opening liability and that of the finance cost give us the liability during the year. Is that okay? After that, then we subtract our annual lease payments, the periodic lease payments. Because it is an outflow of cash, we subtract it from the liability during the period. The remaining balance becomes the closing liability or the closing lease liability. So let's see how we will present this subsequently. Good. So in the year 2020, or at the commencement date, at initial recognition, the opening liability is 2,940,000. So 2,940,000. Good. So the interest rate implicit in the lease from the question is 10%. So we apply the 10% on this. Good. And this will give us 2,940. That is 10%. So 294,000. So the next thing to do is to add the finance cost to the opening liability to arrive at liability during the period. And this will give us 3,234,000. Very good. After arriving at the liability during the period, then we subtract the annual lease payment. So the annual lease payment is 50,000. 50,000 Ghana cedis. Because it is an outflow of cash, we put it in brackets. So when we subtract, we will arrive at 2,734,000. This becomes the closing liability at the end of 2020. One thing I want you to take note is that the closing liability for 2020 becomes the opening liability for 2021. Is that okay? Good. So the opening liability here becomes 2,734,000. Good. This schedule is very simple. So let's apply the 10% on the opening liability. So we arrive at 2,734,20. So 273,400 as the finance cost. So let's add the finance cost to the opening liability in the year 2021. And this will give us an amount of 3,007,000. Very good. The next thing to do is to subtract the fixed annual lease payments, the same 50,000 Ghana cedis. Put it in brackets. Then we arrive at an amount of 2,507,400. Very good. So we still follow the trend. The opening liability for 2022 is the same as the closing liability for 2021. Is that okay? So we have 2,507,400. Is this clear? The next thing to do is to apply the finance cost on the opening liability. The reason why we are applying it on the opening liability is because lease payments are made at the end of the financial year. That is, lease payments are made in arrears. Is that okay? Good. When we apply the 10%, we arrive at 250,740. Is that okay? Good. So we just add the finance cost to the opening liability and we arrive at a figure of 2,758,140. Very good. As the liability during the period. Then we subtract our annual lease payment of 50,000. So when we subtract this, we arrive at 2,258,140. This is so simple, but take note that the requirement says that we should show how the lease will be accounted for in the financial statements of the dealer lessee in the year 2020 and 2021. So there is no need for us to proceed with the schedule of lease payment and finance cost beyond 2022, because the requirement limited us on only 2021 and 2022, so that we see how the interest rate implicit on the lease will have an impact on the financial statement of A Limited. So the two financial statements we will look at here is the statement of profit or loss and statement of financial position. So let's first of all look at the statement of profit or loss. But take note that it is an extract. So extract of statement of profit or loss. Good. So we talk about the year 2020 and the year 2021. The two items that will appear in the extract of statement of profit or loss, it is the finance cost and the depreciation charge, the annual depreciation charge for the period. Take note that this right of use asset is depreciable, so we have to depreciate it. So first of all, let's calculate the annual depreciation charge. So depreciation is given as cost minus residual value. All over estimated useful life. Estimated useful life of the lease item. Good. In this particular question, the cost of the right of use asset of this lease or this item is 2,990,000. That is the cost of the assets, the right of use assets. So you represent this by 2,990,000. There is no residual value, so residual value is 0. So there is no estimated useful life of the assets. But then under Ifrs 16, when there is no useful life of the assets, what we consider is the lease term. So you can write here a lease term instead of estimated useful life. The lease term of this particular transaction is 10 years. The lease transaction is for 10 years. So 10 years. So 10 divided by 2,990,000 will give us 299,000 Ghana cedis. This is the annual charge for the year. That is the annual depreciation charge. So annually, 299,000 will be charged to the statement of profit or loss as the depreciation charge. So I will say depreciation charge it is debit. We debit the statement of profit or loss with an amount of 299,000 each year. 299,000. Very good. The next thing to look at is the finance cost. The finance cost. So the finance cost or the finance charge will also be debited to the statement of profit or loss. And for 2021, the finance cost is 294,000. And for 2022, 2021, it was 273,400. 273,400 for 2021. So this is how the extract of the statement of profit or loss will look like in AE Limited. Is that okay? Very good. So the last thing to look at, it is the extract of statement of financial position. Is that okay? So let's quickly look at that. But take note that the annual depreciation charge is 299,000. We will use it in the statement of financial position. So this is how the extract of statement of financial position will look like. Is that okay? So we begin with the non-current asset. The only non-current asset here is the lease item. That is the right of use asset, and the cost is 2,990,000. So right of use assets. Just have to manage the space so that we complete the statement of financial position here. So the cost remains the same for both years, 2,990,000. 2,990,000. And remember that this right of use asset is depreciable, and we've calculated the annual depreciation charge, and we debited it to the statement of profit or loss. So for accumulated depreciation, for the very first year, it was 299,000. Good. So I'm putting it in a bracket because we've subtracted from the cost of the right of use assets. So this is cost. Very good. So in the year 2021, the depreciation will be accumulated because it was on straight line basis. Twice of the depreciation for 2020 becomes the accumulated depreciation for 2021. So we add this, or we multiply this by 2 to get 598,000. We put it in brackets. Is this clear? That is the accumulated depreciation. And this will give us 2,691,000. And this also gives us 2,392,000. And this is the carrying amount. The carrying amount of the right of use asset. Is that okay? After considering this, the next thing to look at is the liability. Is that okay? The gross liability for 2020 is 2,734,000, and for 2021, the liability at close is 2,507,400. But I would prefer us to split this gross liability into current liability and non-current liability. So let's split that. So you have the current lease liability, you have the non-current lease liability. Afterwards, we had a total, that is gross. So to make it very easy, but you have to pay attention over here in splitting the gross liability into current and non-current. So for the year 2020, the gross is 2,734,000. For 2021, it was 2,507,400. Very good. Now listen and listen good. Let's split the gross liability into current and non-current liability. Listen, the total liability, or the liability at the close of the period for 2020 is this amount. but in 2021 it becomes 2,507,400. So as at 20, it was this in 2020, but in 2021 it became this. So out of this total liability, it was this component that A Limited wasn't able to pay. It means A Limited has paid some. That is why the liability has reduced from 2,734,000 to 2,507,400 within the year. So the reduction in the liability, the difference is the current component that A Limited has paid within the 2020 financial year. The remaining balance that is still unpaid in 2021 becomes the non-current component in 2020 that A Limited wasn't able to pay. Is this clear? So the difference between these two was the current component. That is That is 226,600. That is the current component. So the portion remaining in the year 2021 that A Limited wasn't able to pay in 2020 is the non-current component. That is 2,507,400. Is this clear? So when you add the current and the non-current component, you arrive at the total liability or the gross liability. So now let's split the gross liability in 2021 as well. So the gross here is 2,507,400 and it's here. So to split it, this 2,507,400 is the total liability in 2021. But in 2022, it reduced to 2,258,140. It means that A Limited has paid an amount. That is why it has reduced. So the difference between these two liabilities is the current component of the lease liability that A Limited has paid. Is this clear? And the remaining one is the non-current component. So the difference between these two is So the difference between these two is 249,260. So the remaining liability that A Limited wasn't able to pay in 2022 is 2,258,140. And this remaining is the non-current component that A Limited wasn't able to pay in 2021. That is 2,258,140. Is that okay? So this is the non-current component. So if you add the current to the non-current, you arrive at the gross liability. So I will say this is the gross or the total liability. Let me say total liability. Is that okay? Total lease liability. Very good. This particular video is a special request from a subscriber from Nigeria. So we decided to explain the concept of annuity over here. But one thing I want to include is that we adopt the annuity concept in order to determine this lease liability. And the annuity factor given in the question happens to be this. Happens to be 5.88. In some circumstances or in some questions, even the annuity factor self will not be given. You have to use a formula to determine that. So annuity factor, I will say AF, that is annuity factor. The formula to find this, if it is not given, is 1 minus bracket 1 plus R power N all over R. Good. This is annuity factor. So if the annuity factor is not given, as it is given here 5.88, use this formula to determine it. Where R is the interest rate implicit in the lease. In this particular question, it happens to be 10%. So the 10% will be substituted into R, where N is the number of payment period remaining. Is that okay? Look at this. In this particular question, payment is being made in arrears. It means payments are made at the end of the financial year. So at the commencement date of this particular lease, is that okay? That is in 2020, at the commencement date, no payment has been made because payments are made at the end of the accounting period. That is in arrears. So in this particular question, the number of payment remaining will be 10 years because the lease term is 10 years. But take note, if payments are made in advance, it means payments are made at the beginning of the accounting period. If that is the case, then if it happens that payments are made in advance, it means payment is made at the beginning of the accounting period. Then for this question, we should have said that it left with 9 years because one payment has been made in advance. But that is not the case. Payments are made in arrears. So this is the formula I want you to know. You may see a question where you need to apply it. So this is the end of the concept of annuity on how lease transaction will be recorded in the financial statements of a dealer lessee and how the finance cost will have an impact on the financial statements. So if you haven't subscribed to this channel, I will encourage you to subscribe to this channel, turn on your notification bell so that any moment I upload any new video, you will get notified. Until we meet, I think it is bye for now.